All right, today we're going to dive into a classic trading tool. It's all about measuring something you can't see, but you can definitely feel in the market: momentum. Believe it or not, this thing was developed way back in the 1950s, but you'll see it's just as powerful today.
You know the feeling, right? You're watching an asset just go up and up and up. You're just sitting there thinking, okay, how much longer can this possibly last? It feels like it has to run out of steam at some point, but the real question is, when?
Well, what if you had something like a momentum meter, a gauge that could give you a hint about the energy behind that price move? That's exactly the kind of tool we're going to break down today.
So to really get how this tool works, you've got to understand the big idea behind it. The guy who created it had this core philosophy that momentum is a leading indicator. In other words, momentum changes before the price does.
The inventor, George Lane, had this fantastic analogy. Picture a rocket launching straight up into the sky. Before it can turn around and fall back to Earth, what does it have to do? It has to slow down first. Its upward momentum fizzles out before its direction actually reverses. And he argued that markets work in the exact same way.
So how do we actually track our market rocket as it starts to slow down? Well, we use a specific tool built for just that, the Stochastic Oscillator. I know, the name sounds a little intimidating, but trust me, its job is really simple.
At its core, all the stochastic oscillator does is compare where a price closed to its recent high-low range. That's it. It's just looking at that relationship over a set period of time.
Think about it this way. If prices are consistently closing near the highs of the day or the week, that shows real strength, right? Strong upward momentum. But if they keep closing down near the lows, well, that shows weakness. The oscillator just gives us a way to measure that.
Now, when you look at the oscillator, you'll see two lines. The first one is what we'll call the fast line. This is your real-time, right-now snapshot of momentum. It's the most sensitive part of the indicator.
The second line is the slow line. Think of this one as the backup singer. It's basically a smoothed-out average of the fast line, and its job is to help confirm the bigger, more stable trend in momentum by filtering out some of the day-to-day noise.
Okay, so we've got a fast line and a slow line, both measuring momentum. But what do we actually do with them? How do we turn that into signals we can actually use? What is this meter really telling us?
It really boils down to three key things you want to watch out for. First, when the indicator moves into what we'll call extreme energy zones. Second, when the two lines cross each other, that's a crossover. And third, and this is often the most powerful one, is when the meter and the price start telling two different stories. That's called divergence.
Let's start with those extreme zones. Remember our rocket? When the oscillator climbs way up high, it suggests the upward trend might be getting overstretched, like the rocket hitting its peak altitude. And on the flip side, when it drops really low, it's a sign that the downward trend might be running out of gas.
Next up, crossovers. This is your more immediate signal. When that fast line cuts across the slow line, it's like a little flag popping up saying, hey, pay attention, a shift in momentum might be happening right now.
And finally, divergence. This is the big one. Imagine the price on your chart is making a brand new high. Awesome, right? But then you look down at your momentum meter, and it's actually making a lower high. See the disconnect? The price is going up, but the energy behind that move is fading. That's a classic warning sign that the trend could be losing steam.
Okay, hold on. Before you run off thinking this is some kind of magic bullet, we absolutely have to talk about its limits. Because like any tool, this momentum meter isn't perfect, and you really need to know when it can be wrong.
So let's be super clear here. This thing is not a crystal ball. It doesn't predict the future. It's a tool that's really good at measuring one specific thing: momentum. And just like any other tool, it can be fooled.
So here's when you need to be a little careful. In really choppy, volatile markets, it can throw off some false signals. And in a really strong trend, it can stay in that extreme zone for a long time, which can be misleading. It actually works best when prices are just bouncing around in a range. And the most important rule of all, never ever use it by itself. Always look for other tools to confirm what it's telling you.
All right, let's zoom out and put it all together. What's the big picture here? How should you really think about using a tool like this?
The most important thing to take away from all this is really a change in your mindset. The goal here isn't to perfectly predict the exact top or the exact bottom. The goal is to use this tool for what it was built to do, to get a read on the energy, on the momentum that's driving the price.
So instead of asking that impossible question, what's the price going to do next, this tool lets us ask a much smarter one. How much fuel is left in this trend's tank? And sometimes, knowing the answer to that question can make all the difference in the world.